Welcome, everyone. My name is Kirsten Loita, and I'm the Senior Vice President of University Relations at Osage University Partners. We're excited our partner institutions are joining us today for a discussion with our investment team on startup financing trends to understand current market behaviors. As we are a little more than halfway through 2017, we thought it would be a great opportunity to have a discussion on the state of venture capital funding for startups so that our partner institutions' technology transfer offices can ask questions they may have on particular industry sectors. You'll notice a poll appearing on your screen at this time. If you could fill this out, we'd love to know how many people are attending this webinar. In the meantime, why don't we go around our room of panelists so everyone can introduce themselves. Anurag?
Hi, this is Anurag Agarwal. I am an associate here on the life science team. I have a background in cell biology and consulting.
Hi, this is John Lee. I'm a principal here on the tech side. I focus largely on software, both enterprise and infrastructure software. And I've been with Osage for over 5 years now.
Hi, I'm David Dorsey. I'm an associate on the tech team. My background is electrical computer engineering and looking at investments in healthcare IT, in networking, and other enterprise software companies.
Hi, my name is Manny Stockman. I'm an investor here on the tech team. Been here now for about 2 years. My background before that was in applied physics and sensor development. Look at a lot of our hardware opportunities as well as materials and where software meets hardware at Osage.
Hi, this is Stephanie Stamen. I'm on the life science investment team here at Osage, and I'm also a cell biologist by training and was most recently with HIG Bioventures, a life science venture capital group down in Florida.
Great, thank you, everyone. So what's the pulse on mid-year venture capital investment? Which sectors are facing funding challenges and which are flush with cash? How does this apply to advancing university technologies? Our goal today is to provide guidance regarding how to think about each of these sector markets overall, to cover current areas of investment interest, and, as time allows, to provide suggestions on how to advance university-originated technologies. The webinar will be structured as a panel discussion with Q&A, with slides containing data points relevant to our discussion. The slides will be provided by email to each webinar registrant. If you'd like to submit a question during the webinar, please use the Q&A feature on your toolbar. Sometimes I will rephrase or combine questions when asking the panelists, so you may hear the substance of your question addressed with different wording. I'm going to turn now to David Dorsey, who will get us started and present a few slides on overall current venture investment activity in the market, comparing the number of deals versus dollars invested, followed by a deep dive by our panelists in each of the following sectors: software, artificial intelligence, hardware, autonomous driving, therapeutics devices, and diagnostics. David?
Thank you. So the graph that we have up here shows a picture of the number of deals by year. And there's an orange line here that shows the deal value. That's the number of capital that was invested. What's worth noting here are a couple obvious trends. First of all, that the venture investment activity overall seems to be returning to historical norms after 2015. So 2016 and 2017 look to be kind of a flattening in the number of deals, but not necessarily in the amount of capital that's been invested in total. You know, one of the points worth noticing here is the decrease in the number of first financing. So it looks like angel and seed stages really represent the most dramatic drop-off in venture activity, and they're definitely going through an adjustment. Part of this, this actually represents us 8 straight quarters of a decline in deal activity for seed and angel stage. Now, some of this may not necessarily be due to the fact that there is limited capital in these stages. A lot of it may actually have to do with the way that startups are changing their strategy for growth in an early stage. A lot more often now we see early stage companies are going through corporate and large accelerators where they get startup funding, they help grow their business plan, and they come out ready to, after some additional modifications, go to raise a Series A. And so I think what you're seeing now is probably less often where you have startups that are raising 2, 3 seed rounds before they raise their Series A. So that's also worth thinking about. one of the nice things about that is that the startups, when they come out of these accelerators, have a much more developed business model. A lot of them are going through things like the I-4 program. They're getting mentorship, and sometimes they're getting customers, and which also puts them on a nice track to skip the additional stages of seed capital. So it's not all bad news here for early stage. One of the other things that's worth noting here is you can't, the latest data I just looked at recently for Q2 2017 shows that the deal value as of Q2 is probably on pace to top 2016. So the amount of capital that's being put in is staying flat or we're increasing slightly. So it's, I think the overall takeaway is that the venture investment activity is kind of returning to historical norms from a frothy 2015 environment, but it looks like a healthy and stable atmosphere. You have the next slide? Next slide here breaks things down according to quarter, so you can get a better glimpse of the number of deals and where these break down. So what you see actually is the number of deals per quarter has been gradually declining since about Q2 2015. And in that decline, the late stage deals actually showed an increase. So the majority of the number of the decline in deals is, as we were just saying, really taking place at that seed and angel stages in the first financings. But in the second quarter data, which is also, I was saying, we looked at recently, both the early VC and later VC stages both see increases after Q1. So that trend continues, and this is just a little more granularity to look at that. Go to the next slide. These next couple of slides are showing sort of an overview of the sector trends. And really the story is that they're sort of just, they look the same, and they've looked the same for quite some time. Software is dominant here. The light blue bars at the bottom of these breakouts show software to be about 40% of the total number of deals that are in 2017. There were 40% of the deals in 2016. So, more than a third of the new deals are software in Q1. But if you, the way they break this out here is that little slice of orange is just pharma and biotech. So you have 7% of all the deals in 2017 so far are pharma biotech, 6% in 2016. But if you really add up all of the different healthcare startups here, healthcare accounts for 20% of all the deals in the first half of 2017. And that's that's an increasing trend, actually. And part of that is because, and I think we'll get into this a little bit later, is that there's a lot of overlap now in healthcare and tech investing. There's a lot more healthcare IT software startups, which are part of this 37% in software. And you also see a lot more tech VCs starting to enter the game and invest in healthcare deals. We'll get the next slide. And so what the last slide here shows is that the life science deal share is actually increasing over time. So the amount of capital being put into life science deals in 2017 is on par to be better than 2016 and may increase additionally in the following year. In fact, the deal value for life science is likely going to hit a decade high this year after looking at the first half data. Pharma clearly attracts more dollars, but there's a split between pharma, devices, supplies, healthcare IT, and data that's really even between the number of deals. It's just the capital deployed is a little lopsided toward pharma. I think, when Stephanie gets into this later, she'll talk in a bit more detail, but the real takeaway is that there's actually a growing increase in the number of non-pharma deals. They just don't, the deal size isn't as big.
Great, well, thank you, David, for that overview. Now we'll head into our sector-specific slides. John's going to talk with us about software and artificial intelligence.
Hey guys, so as far as software, 2017 has really been a year full of exits in the IPO market, which had been closed for a number of years prior to that. So some notable IPOs this year have been Snapchat, MuleSoft, Twilio was at the end of last year, Okta and Cloudera have all gone public this year, and we still have some big ones up in the horizon. I think Airbnb is probably the biggest for this year, and then we also have Forescout and AppNexus and a handful of other companies. The performance on those IPOs have been mixed. There's been substantial down pricing from the last private rounds of a number of these companies, which has fueled maybe some later stage disinterest or later stage private investing in some of these quote unquote unicorns. I would say that generally some of these companies have done quite well, though overall it's been pretty mixed, but we'll see how it turns out and what it does for the 2018 IPO market for software. The IPO market is important because eventually it will determine venture investments. As the space becomes more attractive on the IPO side, it should accelerate more venture investments. We're in a situation now where it's probably a little bit rosier to get valuations or higher valuations on the private side than it is on the public side. And I imagine that part of the decrease in venture activity is a correction in response to that. Some other observations in the general software market is a good metric is to measure what the valuation multiples for software as a service companies is, and usually that's a multiple on revenue. And historically, it's generally been around 5x on revenue generated, which is the valuation of that company. In the past couple of years, it's floated up to around 10x to 7x last year. It's actually decreased this year to 5x from 6x. And so we're starting to see kind of a correction in the software as a service market where a lot of these companies haven't been able to exit, but have raised capital at pretty high and rich valuations. And we've seen some good corrections there, which make it more attractive as investors. And then another early observation, or an observation on our end, is that we've seen a dramatic increase in cybersecurity or early stage cybersecurity funding in 2017. I would say that 2015, 2016 were pretty drought heavy on the early stage cyber investment side, largely because there was such a bulk and hype around investing between 2012 and 2014. And so this year we've certainly seen a return to investing in cyber companies, but certainly at valuations that are not overly high or out of market. And then I'd like to highlight a number of emerging trends within software investing that are kind of dominating a lot of the more interesting startups in the space. I would say that the biggest trend right now is something called serverless architecture, which is an entirely different paradigm for how we develop architecture for applications in the cloud. And so I would say over the last few decades, we've invested a lot of capital in what is our current infrastructure for software in the cloud, which has been really glued together with a number of different layers added onto it year by year. 2 years ago, Amazon introduced something called Lambda, which is in other words called serverless architecture, which is essentially abstracting a lot of the core infrastructure of deploying applications to the cloud away from the software developer. So it makes it a lot easier for a software developer to deploy applications in the cloud without having to worry about the underlying infrastructure. And this is certainly moving from being very relevant in niche applications to general purpose computing. And I think we'll see this trend continue pretty strongly forward in the next few years. It is still pretty nascent, and it's still definitely the wild, wild west, but there's a lot of activity going on in that space to make it much more mature. Another item, or another topic that we've seen a lot in a lot of companies that we've looked at is streaming data and edge computing. As more edge devices are out there, like Internet of Things devices, cameras, echoes, etc., we've seen a lot more desire to process computing at the edge rather than sending information back up into the cloud. And so this is an area that we're looking pretty deeply at. And then the biggest other emerging term, which I would say is probably kind of in the middle of its hype cycle, is artificial intelligence. And so in the past few years, kind of starting in 2012, 2013, we've seen a dramatic increase in the types of companies calling themselves artificial intelligence companies. This here is a sector map of by year, by quarter, over on the x-axis, and on the y-axis is the different sectors in which there have been investments within AI. I would say that this market is highly overheated, and that what we've seen is that general purpose and core technology AI companies are quickly getting commoditized in terms of algorithm efficiency or accuracy, and that we're seeing a lot of vertical AI plays coming onto the market more recently than before. A lot of these companies come out of university research labs, just largely because that's where a lot of the fundamental technology has come from. But I do think that there will be a transition to more startups coming out of just the general population as the technology has become commoditized. And I would say that there's a lot of money being thrown around in the AI space at a lot of different deals, and it's something to watch out for. The valuations are extremely high, and rare few companies have built real businesses on them. So I think the space is overheated, but one to watch. If I were to make or place bets in artificial intelligence today, I would look at the more vertically integrated AI companies where AI is just a piece of the stack rather than the focus of the company.
Great. Good advice, John. Thank you. Manny, want to move on to hardware?
Sure. Thanks, John. So the hardware sector has always been an active area of investing for Osage, and you just have to start with saying it's not software. Software, as John described, is the focus of the tech investing world. I just wanted to highlight one of the main reasons why. John touched a little bit on exit multiples, and in software where you can garner these 5 to 10x type multiples on revenue. Typically in hardware, your multiples are around 2x or 1.5x if you look at some of the public companies. And so it makes it a harder area to exit very large returns. And so that being said, you look for bigger companies, you look for bigger swings. And what's been happening recently in the hardware world has been interesting. So recent data is showing that hardware startups are seeing a higher uptick in their valuations from round to round. So hardware saw an 81% uptick in their Series B valuations over their Series A valuations, while software only sat at around 42%. So this was surprising information to us. And it could be a sign that hardware startups are just coming a little bit more back in vogue. And we think that's happening because there's been some retrenchment from the consumer mobile software space. Just too many copycats that didn't really succeed. And so venture dollars are, from what we've observed, are returning to core technology investing. And oftentimes that's in software, and oftentimes that's in hardware. And the good news is we've seen more interest in university startups, it feels like, than in the past. And we try, it's hard to get data on hardware investing alone, but I've tried to pull up the most relevant data set I could find, which is on the right, which is dated back to first half of 2016. And this is just investing dollars over the past several years. And there is a significant uptick. And the reason why it's hard to get this type of data as well as we can for software investing or for therapeutics investing or med device investing is because hardware covers a lot of territory. You could say it covers clean tech, it covers materials, it covers obviously devices. And more so now than ever, hardware is being combined with software so that startups can access those higher multiples that John was talking about. And that means that their sectors are getting confused, but it also, I must say, it makes them more attractive to us. And so when you find startups that are that do have a strong software element to what their core innovation is, which is typically within the hardware, it creates for a good business model. And some examples are a company called Lytro, which makes a very impressive light field camera that only their software can really interpret the data. And that means that they can charge an annual recurring fee on their software and gain more than just a maintenance fee on selling a piece of hardware. And so, the other aspect of the sector that we're seeing is, like I described, a big swing investments are on the rise. Autonomous driving, which I'll get into in the next slide, is I think it's the early stages of its hype curve, and it's incredible how much hype there is around it already. And things like quantum computing are getting a lot of attention and a lot of investment. These are things that are emanating out of universities that we pay attention to and that we'd be happy to talk more about on calls with you all. And one thing I will mention, because we do see a lot of this out of the university space, is that wearables investing has fallen off. Several years ago, there was a lot of hype around the opportunity behind wearables, and what we've found is that for the different types of components that people might develop, biometric sensors, things like that, it makes for a really hard business model and a really hard design win. And as I was describing earlier, you don't really have a good software cycle that you can put around these things that generate a lot of money from consumers. And so that being said, the trends that I would like to highlight to you all, I'll jump into autonomous driving in a second. But in edge processing, this is where you're starting to offload some of the cloud work to more localized systems. There's a lot of interesting hardware, software opportunities, chip design and things like that. Robotics is always going to be very intriguing if you can come up with the right model around that. There's definitely some interesting use cases that we've seen as people think about mobility and not just autonomous cars. And as well, everything that we've seen in computing from our corporate contacts is pointed to Moore's Law truly coming to an end. I mean, there's no vision beyond 3 nanometers right now. Their scientists are stuck. And so we're seeing interesting things in photonics, approaches to computing, quantum computing, and even ways to get better performance from your existing chips, given that you can't rely on Moore's Law scaling anymore. And so over to the right are some companies that we just think are worth highlighting as great hardware companies, some of which are in similar sectors. There's things like rocket companies that are being invested in out of universities, and interesting kind of ARM killers. ARM is a semiconductor company. And so, we are really focused on all sectors here on the tech side, and hardware is one that we're paying even more attention to than we used to. So if we jump to the next slide, I'll just quickly kind of highlight some of the hype around autonomous driving, and I'll just start from the bottom. There's a stack, and it's a race to the top of the stack because that's where all the value is. This is why all the OEMs like Toyota and Ford are scrambling to do autonomous driving, because Google has crept in to show that they can perform, and that software is going to ride on top and make all the money, not just the platform itself. But starting at the bottom where it's more simple, you have sensors. Anything that's in the radar, LiDAR space has been really relevant for autonomy. Specifically, LiDAR from all our OEM diligence has highlighted as like the top of the problem for them. And you also have a lot of interesting semiconductor developments in the processing side of the business, where NVIDIA sees it up as an opportunity to grow in places where ARM and Intel are not. And we've seen a lot of interest from in the venture industry in investing in those spaces, and we are too. And the reason why, in general, autonomous driving is different than previous views into the automotive sector is because it's short-circuiting the entire development timeline of a startup working with Ford and with other major automotives like that, because they're in such a scramble to get as much technology in as soon as possible that they're generating significant NRE contracts beforehand, and we think that autonomous driving is going to become a 2-year type automotive development timeline, not the classic 5 to 6. And just as always with automotive, the volume is just massive, and so a couple design wins with 2 OEMs can make your company, and there's been a lot of response and acquisitions for that. So I'll stop there and pass the mic back to Kirsten to move on to the next section.
Thanks. We actually have a couple of questions. So one is about someone would like to get more information on the LiDAR startups, who they are, et cetera. Where they can get that kind of information?
So there's a couple sources. One is me. Our team's been looking at that space for a while, so feel free to reach out to me, and I can kind of give you something I've already prepared in that space. And then, if you look at some of these kind of venture summary websites that like Crunchbase or CB Insights, they've done roll-ups of some of that discussion on the top LiDAR startups to date. But if you can't find the right information for yourself, don't hesitate to reach out to me.
Great, thanks. And then for all of the tech teams, John, David, and Manny, Another question we had was regarding quantum computing technologies out of universities. In what universities are you particularly seeing these opportunities that really have an eye towards commercialization of these technologies?
Dave, you want to answer that?
Yeah, I mean, so we're looking at, you know, 2-3 universities that right now have quantum computing efforts. One of them is Yale University at a Rob Schokol's lab. He has a company called Quantum Circuits. There's also, Manny can tell you more about IonQ, which is at University of Maryland and Duke University. And I would say, you know, the question is asking about, you know, commercialization. I would say these are very early stage startups. You know, the commercial market is not really, it's not really clear what the commercial market is. There's a lot of excitement about the possibilities of what a quantum architecture could allow. And so I think it's still very early stage, but there are definitely some efforts. So there's Rigetti Computing, there is IBM has an effort, Google has an effort. There was early on D-Wave, and there are probably a few other you know, major companies that are well funded. But the ones out of universities we're seeing right now are Yale, Duke, Maryland, unless I'm missing some.
I'll just add that there's probably some we don't know about. It's been a fast-moving space, so other universities like Waterloo, Toronto, Berkeley all have quantum computing efforts. There's probably some we're missing in there that they're all very active research. It's an active research community, and they all know each other.
Great, thank you. Please do have the questions continue coming in, but we will, in the meantime, move on to our life sciences sector, going to the therapeutics sector. Anurag.
Yep. Thank you, Kirsten. Therapeutics has been for many years been the mainstay of venture investments, and I think if you talk about the traditional life science VCs, both in terms of the number of deals and the amount of dollars invested, has been heavily weighted towards therapeutics. And I think that is reflective on our OUP2 portfolio as well, which has been primarily on the therapeutic side. And I think, as David mentioned, 2015 has been a very frothy year, and things after that are now starting to level out. And we are seeing the same trend in therapeutics as well, as the number of deals that are being done has decreased from 2015 to about 534 in 2016. However, if you look at the first half data of 2017, it's in part to be in line with 2016. Similarly, the number of dollars invested quite mirrors the number of deals being done. 2015 was a blockbuster year of $10 billion being invested, while only about $8 billion, around $8 billion being invested in 2016, and 2017 is on, like the first half of 2017 indicates a similar level of investment as 2016. So all the frothiness of 2015 is settled down, and now we are getting to a more stable investing in therapeutics as well. And not many surprises in what is really attractive in therapeutics. Oncology, which has been and expected to stay as the most attractive option for the investments for the VCs. Those are both related to what comes out of universities, heavy NIH dollars being poured into oncology research, and big unmet need in the areas. So venture investors continue to pursue oncology as one of the key areas. But the other areas, which has really come up in the past few years has been orphan disease, orphan and rare disease. And this was ranked at number 5 in 2015, at number 4 in 2016, and now it's at number 2 in the first half of 2017. And there are a wide variety of drivers for it. And some of it which have existed in the past, and some are the new things that are driving this. In the past, we always knew the time to exits are lower, the rare disease have attractive clinical designs, FDA is incentivized to look at more technologies in this space. However, coming up with the new technologies of CRISPR, the gene editing, the regenerative therapies, which are all being initially targeted towards rare diseases and orphan diseases because of the attractive clinical path, they are really driving investment into these areas and focus of VCs into this. And I think that is driving a lot of this ranking the orphan disease higher. And wouldn't be surprised if that trend continues for a few more years as these new technologies play out in the market. So if we look at outside, outside the rare and the oncology, the CNS continues to be attractive. We have seen some really good, IPOs. Biohaven, one of our OUP2 portfolio companies, had one of the largest IPOs, one of the 3 over $100 million IPOs this year. Ovid Pharmaceuticals has been similarly, a very good IPO in the neuro space, and so that's an attractive area for investment. Some of the areas that continue to not be an option or not an attractive place for the VCs to go in, and these are like cardiovascular, diabetes, pulmonary diseases like asthma. And if you look at them, they have some key characteristics. They are long-term management diseases with significantly good standard of care today and very limited innovation happening there. For example, PCSK9, it really did transform the cardiovascular market, but was a one shot, and since then things have been more stable, and therefore from the venture investment that has been less attractive. And moving forward, a few other things like cell therapies may revive this market, but will also be in a very niche population rather than cardiovascular and diabetes population as a whole. Get to the next slide. So if we look at the therapeutics on a much more granular level, something that David mentioned was that a lot of early stage deals, the dynamics have changed, and that is true for therapeutics specifically. And one key thing that highlights is, in previous years, if you see, therapeutics, 2016 number of deals being done was one of the least in last 4 years. However, the number of dollars invested was actually second highest after 2015. And what this means is that though lesser number of deals are being done, more amount of capital is being deployed per deal, which is showing a significantly higher Series A, which is in line with what David was saying. These companies are much more mature maybe, or the venture investors are seeing a longer path to take it rather than doing multiple seed rounds and then getting to Series A. And if you look at it, in 2016, the Series A investments went up by 50%. And I think 2017 is also in line to do as well as 2016. The other thing that came out, if you look at the data, was that the corporate investors, these are strategic investors, have really started playing a role in the early stage investment. And they accounted for 31% of the Series A investment in 2017 so far, compared to 23% in 2016. And so you're getting new avenues of raising capital outside just traditional VCs, and similar things are coming out from family offices, from large funds of funds like Temasek directly investing into companies, and therefore there is a lot of alternative funding options that are being opened. However, the investment in early stages are increasing. The M&A and the IPO market has kind of slowed down. And the slowdown is very relative, is because of the strong market in 2014 and 15 drove a lot of IPO and mergers, but 2016 and 17 have been lower than that, but are actually much in line with what industry has seen in the past. So it is relatively slower, but still pretty good. And 2017 has already seen about 15 IPOs this year, which is in line with what we are seeing, we are expecting to see in 2016. So it seems like things are leveling off. If we now double click into different therapeutic areas and just go through them a little bit more on what we are seeing, what gets us excited, and what gets the venture community excited in general. As you see, the top 2 things that we have listed are oncology related. Oncology still remains the mainstay of investment, and if you look at traditional oncology investments, things like the new pathways, like proteasomal pathways or cell metabolism, are still very attractive with novel targets. On the other hand, you'll see that the targets that were considered very difficult to drug now are becoming hot again with new technologies, like targeting KRAS, targeting P53 or Wnt pathways. One of our portfolio companies, PMB, has been looking at targeting P53 and then raised more than $70 million in their latest funding round. So these still targeted kinase inhibitors are still very attractive, but for specific pathways. Immuno-oncology, as we all know, has been growing and has changed, revolutionized our oncology treatment. They continue to be very attractive with bispecifics coming into the play, and along with cell therapy, which has truly taken it to the next level. But the cell therapy, because of a lot of concerns and pricing issues with it, the venture investors are looking at the cell therapy 2.0, which is going to solve the issues of cell therapy today. These could be the safety concerns that we have. It could be targeting the tumor microenvironment or expanding the horizon outside the T cells and going towards other cell types like NK cells or macrophages, like the Karma Therapeutics from UPenn being an example. So those new avenues are continue to be exciting for venture investors. A few others that I've listed that I would like to actually talk a little bit about is, one is antibiotic space. Though antibiotics is actually very interesting, and today only there was announced a big investment by Versant Ventures in an antibiotic company. These investments are quite a bit on the late stage companies. So they have developed the products quite significantly to a much late stage preclinical. And that is what is drawing investment, which is driven by, higher risk with these antibiotics and also lower M&A values that, corporates have given to antibiotics in general. And so an advice here would be is the assets that are in-house could be developed through some alternative funding, so non-dilutive funding, to take them to a stage that are very close to IND before actually raising outside capital, which can still is feasible and attractive for VCs. And the third option that I would want to focus on is fibrosis. It has seen a deluge of capital being thrown on in this field. However, what you would see is the capital has flown towards novel mechanism of actions rather than repurposed diabetes drugs. So these are new pathways like our portfolio company Blade focusing on calpains, or Pliant focusing on integrins or inflammation. And so novel pathways which are outside diabetes are also attractive. As soon we learn more about fibrosis, we understand that fibrosis is much larger than just diabetes specifically. And other than that, CNS, orphan rare, and microbiome continue to be attractive, and there are specific areas that can be attractive in them, and we can discuss if you guys have any specific questions in those.
Perfect. Thank you, Anurag. We'll get to any specific life science questions after Stephanie presents on devices and diagnostics. Stephanie.
Great, thanks, Kirsten. So on the next two slides, I'll be covering the device and diagnostic sectors. And while these sectors lag far behind therapeutics in terms of investment activity, there are actually a few bright spots that I'll get to. First, though, overall device investment in 2016 continued to decline off of the high that was seen in 2014. And this is in terms of both the number of deals done and dollars invested. And 2017 looks to be off to a fairly strong start with $2.9 billion invested thus far, but this number is actually driven by a few large outliers. So the expectation here is that funding activity will be roughly flat to that was seen in 2016. There have been several active investors in the device space in 2016 and then in the first half of 2017. So J&J Innovations is leading the pack with 7 investments since 2016, and there continues to be strong investment activity from other strategic VCs. There's also been increased activity from both family offices and private equity funds. These have tended to be primarily late-stage investments, but they have made some earlier Series A stage investments as well. And then the one notable absence on this list of investors is NEA. So they're typically fairly active in the device space, and while they are not on this list, they did just close on a recent very large fund where they have apparently allocated about $300 million to device deals going forward. So moving then to diagnostics. So the diagnostics sector continues to show some early momentum in 2017 and is actually on track to exceed the number of Series A deals that was seen in 2016. And in terms of investment level, the 2017 will likely end up being fairly similar to 2016. The sector, though, still really struggles with exits, which makes it very challenging then for investors. So M&A activity decreased. There were 8 deals in 2015 that dropped to 4 deals in 2016, and there has actually been no M&A activity so far in 2017. So that's continuing what is now a 3-year decline. IPOs for diagnostics actually look even worse. So there were no diagnostic IPOs in 2016 or thus far in 2017. And this is likely due to what has been fairly poor aftermarket performance in the previous IPOs. Now, one nice change to highlight in the space, and this is something that David had mentioned earlier in his overview. So there's this emerging trend of increased diagnostic investment activity from more traditionally tech-focused VCs. And this was first evident in 2016 and has continued pretty strongly so far in 2017. The space is also seeing strong activity from angel investors, corporate VCs, and firms outside the U.S. So while activity from the more traditional life science investors has continued to decrease, there are new investors that are moving into the space. And with that, I will turn things back over to Kirsten.
Thank you very much, Stephanie. So first question for Anurag and Stephanie that I have is, we've heard in the past that there's this feeling that there's a dearth of early stage life science VCs. What are your thoughts on that? What do you see?
Well, so I would say for early stage therapeutics investments, I actually think we're seeing a huge increase in the number of VCs that are taking on their own company formation role. So I think we've seen a lot of increased activity there with several venture groups that have now raised funds purely for the role of company formation. So they are very actively looking for early stage technologies.
Yeah, and actually the data supports similarly. If you look at biopharma VC fundraising or healthcare VC fundraising, which is primarily on the biopharma side, the last 2 years have raised about $7 billion. And first half of 2017 has already seen $5 billion in capital, with NEA being the major contributor of $1 billion fund, and they invest in early stage to late stage. But as Stephanie mentioned, there has been many funds and many new funds, along with some existing funds that are raising a new, another fund for themselves, have both contributed to increase in early stage funding. And I think the other addition is the corporate ventures. They have started heavily investing into Series A and even at company formation stage, like SR1 from GSK or AbbVie Ventures. And I think Takeda Ventures are revamping their own growth. And all of these will actually lead to a significantly higher investment in early stage deals.
Yeah. Great. Well, thank you. And I would encourage our audience members, if you have any questions about this, please do contact us and we can provide you more information. We do have one other question from the audience regarding software. John, what stage of development do venture capitalists usually start investing? Is it after a beta, after initial marketing of software?
Yeah, I would say that it fluctuates a little bit in software, but the most traditional software investing, it depends a little bit on the type of venture investor. So I would split the seed stage firms versus the Series A firms. So the seed stage firms are the guys like First Round Capital, Upfront Ventures, some of the micro VCs that are investing probably sometimes pre-product at prototype or just at product. And then the Series A guys are probably investing after some commercial traction. The rule of thumb is generally about $1 million in recurring revenue would justify a pretty good and healthy Series A valuation.
Okay, great. Thank you. Well, we are actually approaching the end of our webinar here. Before we run out of time, we would love to collect everyone's feedback on this webinar. You'll notice a link to a feedback survey in your chat box. If you could fill it out, we would greatly appreciate it. Before we sign off, though, I'd love to ask one other question of our panelists. Go around the room and ask each of you, what is the one piece of information that each of you would have advised our attendees to take away from the presentation today? And I'll start with Stephanie.
Sure. So I'll tailor my response to focus specifically on devices and diagnostics. And I would say, when thinking about who you can be sending, early stage device and diagnostic technologies to, really think about finding the right fit in terms of the investor. So in both of these sectors, the traditional life science VCs have started to move away, but we have seen these new groups coming into the space. And so really think about, reaching out to family offices or, private equity funds, and then on the diagnostic space, tech VCs as well as, smaller angels, and even firms outside the U.S.
Great, thank you. Manny?
I'd say, there's no bad sectors, just bad business models and bad business plans. In certain areas that have not been as active, areas that I'm interested in, like materials, even some clean tech and energy technologies, it's not about, that just being a sector people won't invest in. It's just that it's proven that the business is hard to develop. And so as a company, if you're in those sectors, it's about trying to come up with a unique way to approach the customers that you'll be working with, and not reinventing the wheel.
Great, thanks, Manny. David?
Yeah, so, what I would say is we see an awful lot of really good ideas that are coming out of universities that still need some work on their business plan, and they're having difficulties because it's hard to find that early stage seed funding. And so what I had mentioned earlier, there's a growing trend now of sort of looking for an accelerator or a program that will help with the business model. And there are a lot of programs like that, and I would say to the startups to avail themselves of the accelerators both in the university ecosystem. I know Columbia has 4 accelerators. University of Chicago, New Ventures has a very good accelerator, and then also Techstars, in particular corporate accelerators like Microsoft help to find great partnerships that can lead to early pipeline for a company. So before they have a sales force and they can go out and sell their product, and they may have say a co-sale agreement with the corporate partner that leads them through the accelerator. So I would just say to those startups that find themselves in a situation where they're looking for early capital, look at accelerators as a good way to get both the capital and the experience to lead them to a Series A.
Great, thank you, David. John, what in particular would you advise our participants to take away from today's webinar?
Yeah, so I would say that in terms of I'll just speak specifically to software investing, but in terms of software companies, there's always a flux and a hype of different types of architectures. So I think every now and then you see kind of large paradigm shifts, and I think that we're seeing that in the software sector and in both in AI and then also in serverless architecture. So I would kind of look beyond the curve on both of those things and just always be looking out for what's next on the horizon.
Thank you, John. Anurag.
Yeah, on the therapeutic side, I think the big takeaway for me would be is there are many more additional ways to raise capital rather than just traditional VCs like devices. It may not be the tech VCs, but it is now family offices, corporate VCs, and even some non-traditional funds like Temasek and TPGs are just now investing heavily into early stage. So casting a wide net and not restricting yourselves to the traditional ways of raising funding is becoming popular and should be leveraged as we increase our spin-outs from universities. Terrific.
Great, thank you all for your advice, and thank you in general to our team here for being panelists in today's discussion. If our audience has any additional questions for our team, please reach out to them via the email addresses seen on the current slide. And again, you as webinar registrants will receive the slides shortly via email. And thank you to all of you for attending our webinar today. Our next webinar will be on healthcare IT, and that will be in the fall. Enjoy the rest of your day and the rest of your summer.